Welcome back to Mondial's second 4 questions with 2 charts, our weekly segment where we try and make sense of the markets for our clients. After the success of our first video, Sean Kelleher is back, and this time with Daniel Jolliffe at Quilter Cheviot. Quilter Cheviot, one of the UK's largest and longest running discretionary investment managers with history dating back to 1771. Daniel has been in the industry for the last 13 years and is an investment director there, managing discretionary and advisory portfolios across all the asset classes for private clients, financial intermediaries, and also trustees. So let's see what he has to say.
At the Federal Reserve and Bank of England level, they are contemplating negative interest rates. What do you believe the impact will be on client portfolios?
So you're right, there has been a lot of discussion about the impact of negative interest rates. I think Warren Buffett recently called it one of the most interesting questions in economics. In terms of the impact of stimulate economic growth, whether it does that is another thing. The impact is essentially that the negative rates are designed to pressurize individuals and banks to not hold cash, because they'll end up having to pay central banks themselves to hold cash deposits. And the thesis behind it is that if you're not holding cash, you either invest it or you spend it. So, rightly so, after the pandemic, people have been holding on to cash because of nervousness, and negative rates are basically designed to give people a bit of confidence to start spending again, and hopefully that will boost economic growth and economic recovery. Like I said, it's happened in Japan, it's happened in Switzerland. They've both had negative rates. They haven't really worked up particularly well so far. So yeah, it's going to be difficult to see it progressing, but it's definitely a route that's being discussed at the moment.
With Main Street not doing very well and companies not making enough money, how are your portfolios dealing with the lack of dividends?
So yeah, a lot of clients have been in contact regarding the kind of cut of dividend income from numerous companies. From a company perspective, it makes sense because it's one of the easiest ways for them to save money, essentially, in this kind of turbulent period. From a client perspective, obviously, it makes things a bit worrying because clients either take an income from their portfolio or they reinvest the income that's been generated. So from their perspective, they're duly concerned. What we're looking at and how we're dealing with it is that we're just looking at alternative options for clients. We're obviously keeping communication open and explaining that over this short time period, income will be affected, but we're looking at reinvesting funds into companies that do pay a dividend if it's required, or simply just kind of holding clients' hands and making them feel at ease, and advising them that the situation can improve in the future. So yeah, there's multiple ways that we're helping clients deal with it.
Okay, we get this question a lot from clients. How do asset managers, who should know a lot more than we do, how are they dealing with the impact of the coronavirus?
So yeah, obviously the impact of the coronavirus has been felt by everyone. How we're dealing with it, obviously at Quilter Cheviot, we invest in kind of multi-asset class portfolios, which means clients don't just have exposure to equities; they've got exposure to fixed interest assets, government bonds, corporate bonds, gold, for example. So the idea behind that, the logic behind it, is that not all the asset classes will be moving in the same direction at the same time. So during March, which was a really bad time for equity markets, the value of our portfolios were kind of, well, they fell less in equity markets because the performance of government bonds and treasuries and gold performed very well. Navigating out of that kind of turbulent period, we're looking at investing into collectives, i.e. funds and companies that are insulated from the impact of the coronavirus, tech companies, healthcare companies, companies that revenue streams aren't affected by the pandemic or haven't been affected by the pandemic largely thus far.
Okay, you've actually covered a little bit of the next question. We can see the direction of travel of your thinking, but how do you see the headwinds for Q3 and Q4 of 2020?
So headwinds, I mean, it's really difficult at the moment to look past the impact of the pandemic and its aftermath. Obviously, it's been life-changing for millions of people. Looking past it, there's other kind of issues that are at hand. Firstly, we can't forget about the impact of Brexit in the UK. That should feasibly be wrapped up by the end of the year, but what that looks like, we're still a little bit uncertain. In terms of the US election as well, that's going to be in November of this year. Whether Trump stays in, whether he loses, is kind of up for debate. I think the biggest headwind at the moment is the aftermath of the pandemic. Really, life has changed immeasurably, hence doing this call today. And also, there's mass social unrest at the moment. We've got a very fragmented society. So how that kind of plays out and how that impacts life as we know it is also an unknown at the moment.
The first graph we're asking you for a view on is one of the S&P with that lovely little fall in March, and of course halfway down that fall everyone was talking about the shape of the recovery, V, U and L, featuring. This one looks a little bit like a V. What's on this graph?
I mean, I set the graph to have a year's timeline for a reason. I wanted to show, I suppose, the upward trend, towards the end of the long-standing bull run in equities. But the main reason I included this chart is because I wanted to show people, the V-shaped recovery as it stands at the moment. Now, that's not to say it's going to remain that way, but when you listen to news feeds, Bloomberg, for example, there are lots of analysts talking about V-shaped recoveries, W-shaped recoveries, and it can all be a bit confusing. So I think that chart highlights perfectly the V-shaped recovery as it stands, which is a drastic kind of short, sharp fall in the value of the S&P 500, but then a more gradual incline, rise, and that's been unexpected to a large extent due to the negative information that's out there. So it looks very much like at the moment markets are looking through the negative information in the hope that towards the end of the year, corporate earnings recover.
We've got a little bit of time in the bank, so I want to refine the question on that graph, because we've got
sure.
As at today, we've got a sort of V recovery. But if you're looking at new money coming in today, would you be saying the investors have missed the boat, or how do you see the immediate track by the immediate next 3 years for new money as at today?
It's a really good question, because I've been in a position where I'm experiencing that situation right now where I've got cash to invest for clients. I think at the moment it's to take things cautiously. and to obviously be wary of information that's coming through to us. I think it would be foolish just to not listen to a large number of economists who are saying, look, the market rise feels slightly overdone at the moment, tread carefully. So it doesn't mean that we're going to sit in cash, but it means that we will look to invest in the asset classes that would provide a degree of safety should there be another significant downturn. So to look into going into treasuries, to look at going into gold, to look at going into our alternatives, which includes absolute return funds. So by all means, we are investing for clients. We're also investing in equities, but we're not necessarily going to commit all of the client's money, especially if they're a new client, into the market straight away today.
Next graph is almost an inversion of the S&P because it's the Open Fear Index. Talk us through what we're looking at here.
Yeah. Sure. So the VIX, or the volatility index, or the fear gorge, as it's sometimes called, is really I suppose a way of looking at the volatility, the predicted volatility, which is going to occur in the S&P 500 over the next kind of 30 odd days. I won't go into how it's calculated because we haven't got time, but essentially it's used by investors to gauge, volatility and market sentiment and investor sentiment. So this is something that's monitored. You can see from the chart that in the height of the downturn in March, the VIX level rose to an unprecedented level of kind of 85. And ever since, it has dropped off, which, like you alluded to, kind of is moving in the opposite direction as most financial markets. So it's used really out of interest to assess what market volatility is at the present time, and it has been decreasing, although there's been a little spark up recently to a level of about 27. Its kind of normal range fluctuates anywhere in between 12 to 15, so you can see in kind of normal terms we're slightly elevated, but again, the fact that it's coming down would be a positive indication in my view. And this is something that I look at regularly. This is something I regularly discuss and share with advisors in my weekly emails as well.